Welcome to Subramoney. I'm continuing my talk about checklists. I have some reasonable checklists which were very different from what somebody like a Charlie Munger would have. I will do a detailed video on Charlie Munger's checklist also, but this is my checklist. So first of all, my checklist could be biased. Second, I could talk about ITC or Coke in my checklist. It does not mean I would invest in ITC or Coke. Maybe I will not invest in both ITC and Coke for the same reason that they're health killers, and I am not too keen to put money into companies which I don't agree with the way they're working. It's not that that is my checklist, that's all. It need not be yours. Like I may have invested in an American fund which may have invested in armaments or which may have invested in Coke. I have invested in mutual funds and ULIP schemes. Yes, I have ULIP schemes which may have invested in ITC. So I'm not worried too much about the fact that I will not invest in ITC or Coke, but I will not invest in it directly. This is like how I eat eggs. I eat eggs in a cake without worrying too much. I may even eat eggs in a chocolate because chocolates bought abroad have eggs. But I would not eat an egg directly. So I don't make a fetish about it, but yeah, that's my checklist and that's how it works for me. And yeah, Charlie Munger, I'll make it separately. So what do I look for before I start investing in a company? To me, if it's an Indian company, Indian managed company, I like it, and it has to be from the West or from the South, or it has to come from a very strong recommendation from somebody saying, even though this company is based in Delhi, it's a good company. To me, I have to be very careful, and the exception is when the companies are companies which are multinationals. So an MNC, so a Maruti Suzuki MNC based in Delhi is fine, and ITC which had 25% of BAT and government and all that, where the owners are not from that location, that's fine. So ITC can be in Kolkata, Nestle can be in Delhi, that doesn't matter, I don't really mind. The Coromandel International, the factory is in Andhra Pradesh, maybe somewhere near Hyderabad, I'm not very sure, but the head office is in Chennai. So company has to be west to south, you know, the corridor. That's where I invest. When there are companies outside the corridor, I'm very, very, very careful, and I actually don't add too many companies. I add maybe one company in a year or two companies in a year. So I'm very, very careful about the physical or the geography of that. I love it if the dividends have been rising, or at least the EPS has been rising at least for 15 quarters. 15 quarters would mean about 4 years or slightly under 4 years. So 15 is a number which I work with, because that's a number with which I worked for one FII for whom I was doing some research. So that is a very important criteria. This cuts out a lot of commodity companies, because commodity companies may not have had such a long run. Forget the recent runs that some commodities are having, but commodities may not have had such a long run. So in those cases, but when it's a commodity company, then I remove this criteria, because commodity company earnings can be very widely fluctuating, and you know that it is going to be widely fluctuating. It may not meet this criteria, but yes, when I'm dealing with commodity companies, I restrict myself to 2-3 commodities where I understand pricing of the commodity, not pricing of the share. It doesn't matter. The price of the share reflects the price of the commodity. So something like gold, I would still go for a world gold fund which has gold and gold mining companies. So I prefer that because the beta is higher, and my exposure to gold is anyway limited to a very small number. So I would prefer a stock with a little bit of beta. I would love when there are very strong entry barriers like ITC. It is almost impossible to enter the tobacco field, and ITC in my head is still a tobacco company, even though people may want to classify it as FMCG and things like that. It's a tobacco company. It makes all its money from tobacco. The profits come from tobacco, immaterial of what other business it does. To me, hotels serve more as a tax planning device. It is not going to make too much money for ITC. But anyway, I don't invest in ITC, so I'm not dwelling on too much on it. I don't like companies like Coke, because I think going forward the younger population may not consume Coke. But however, the growth for Coke will happen in India, China and other places rather than the US. So sorry, that's a digression. I like strong ROE and RONW. The company has to earn more than the capital cost that it incurs. So if in India they're incurring say 11% capital cost, maybe it's lesser, but they have to earn at least 14-15%. Anything less than that does not attract me unless there is some specific reason why I'm looking. But at least when I'm looking at that company, I know that this is the law, this is the rule which I am violating. So for me, a company won't fit in with 15 quarters of rising EPS, and therefore it does not fit into ROE and RONW. Then it requires 16 horses to pull me to invest in that company. I may not, right? Because also understand that when you have 2,500 crores to invest, or maybe 25,000 crores to invest, or maybe 80,000 crores to invest, you have to put a lot more criteria to shortlist, and you have to also justify to a board, you have to justify to your team and all with your biases. I don't have to tell you why I have this, but it has worked for me. That's what I'm saying. This is not going to be very useful for everybody, but those who want to create their own checklist can use this as an indicator as to what all to look at, right? Solid growth or growth prospects. See, what happens is when I look for dividend yield, I'm a very big yield chaser. So you could also call me a value investor. But then what happens is certain companies you ignore because the company is just about starting, or it is establishing, or it is growing very fast. So I missed a Bharti at 30 rupees, but I bought Bharti at 80 rupees. And then I sold off at 1200. Of course, after that it is X bonus and all, X bonus split, whatever. And so today's price is about 750 rupees. So I would have completely missed Bharti, but for the fact that I said, okay, I was told by my broker that Subra, in this all the value will be captured by the growth, and that was, I think, brilliant. So sometimes I have to ignore that 15 quarters of rising EPS may not be there, but I know why I'm buying. I'm buying this as a part of my growth portfolio, not my value portfolio, right? So a Coal India at 110 or 120 was a complete value portfolio. At 250, I may buy it as a part of my growth portfolio. So I'm not saying I will buy only growth or only value. I know why I am buying. So to me, that is very important. For example, a very important hurdle is in 3 years time or in 4 years time, a share has to double. 3 years is my better company is doing it. 4 years is something which I want my company. If a company does not double in 4 years, it's out. There is no point in trying to earn less than 18% if you're putting in the efforts. Could you earn 18% with dividends? Yes, the answer is yes. Yes, in the past. I do not know about the future. Maybe my expectation will come down to 15%. It has also happened that now my aim of my portfolio is capital preservation. I don't need growth. As long as I can preserve my capital and continue to get the dividend which is more than my household expenses, maybe 1x, 2x, 3x, that doesn't matter. I don't really have to worry. If I have a surplus where out of my dividend, after meeting my household expenses, I'm able to reinvest, I'm more than happy, because capital preservation is more or less guaranteed, and I'm looking more at capital preservation. Incidentally, last year, of course, everybody's portfolio grew and my portfolio has also grown, and when I concentrated on PSUs for dividend yields, I did not expect to see so much growth, but it has happened. Reliable customers, take HUL. Fantastic customers, they keep coming back again and again, so that's good thing. But in FMCG, which could be Reckitt and Reckitt, Colgate and P&G, HUL, there is one big thing which is happening, which is very of recent phenomena, is that the distributor is being threatened. The end customer or the shopkeeper is today buying from Reliance rather than buying from the established distribution chain. To me, that's a big threat to the PE of the manufacturers also, because once the distributor is eliminated, it is not that one distributor is being eliminated. Maybe 20 distributors are being eliminated in each state. That is going to be very hurtful. It is going to make a lot of people unemployed, and the PE of Reliance has to change. Maybe the PE of Amazon and Reliance would be captured, and where would it be captured from? It will come from the PE of the FMCG manufacturers. That is a new thing, but anyway, I'm digressing. I'm worried about companies which could have technological obsolescence, because I don't understand technology. That's scary. I prefer companies which have less requirement for capital. So a Colgate over a Bharti or a Colgate over a steel manufacturer would be in my head. But like I said, I'm a little worried that if Reliance can break the distributors, tomorrow will they start threatening the manufacturers also, right? That's a scary thing, because Reliance will become a very big buyer. So if Reliance is buying 20% of my output, I'm sure they can tell me how much they will pay me, rather than, so the brand pricing power of the Colgate and HUL and P&G and Reckitt is going to be tested. If that is tested, the margins are tested, and they anyway don't have great growth rates, then the PE of these companies could be tested. That we will talk about separately. Companies with limited working capital requirements, so a Colgate is preferred over a Bharti. Or Colgate is preferred over, let's say, a steel manufacturer going forward. The steel boom is just fantastic. I'm participating in it, but I'm just saying generally less capital intensive business is preferred. Obviously a lot of free cash flow, and that free cash flow parked in assets which I can understand, like mutual funds, etc., and not hidden somewhere. I would prefer to see cash if they have cash, rather than stuck somewhere as to this is going to be received, set up a subsidiary to do something. Those are a little no, but you can't really help it. Today everybody has many subsidiaries. Then I come to, after I do all this and I've checked out about the promoter being good, and I don't want the promoter to be bad, that's all. I'm not saying he needs to be good, but he should not be bad. So non-negative rather than a positive is what I'm looking for. Then I come to, if I can understand the business, if I can pass through all this, if the promoter is good, then I come to pricing. So when somebody asks me, is the Nykaa pricing good, I don't know. I've skipped the first few stages. I don't understand the business, it's out, right? So it does not go through any of this. I don't come to whether the promoter is good if I don't understand the business. I don't understand the business, the next steps are out, right? Reasonable value of the business. Again, if I can understand the cash flow, how much is the free cash flow and how much is the market cap. If it is dramatically different, I don't understand, I stay away, because, or I put such a small amount that it doesn't matter, because some friend is saying, boss, samajh mein nahi aata hai, it's okay, but it will make money. Then yes, I mean, same thing is how I had to deal even with Infosys in 1993. I didn't understand a shit about software. Not that I do now, but in 1993 I knew I didn't know. Today at least I pretend that I know. There is a big difference. If it's offered to me as a value stock, then I very clearly check out whether it's a value stock or a value trap. That line is very thin, so there has to be regular dividends. It has to be a good dividend yield share. Let's say a Coal India at 150 is still a good dividend yield share, right? So those kind of things. And how patiently will I wait for buying, and how patiently will I wait while selling? Those are the questions which I have to ask myself. Will I wait for 4 years, or if my money doubles in 2 years, will I get out, or will I add? I have to ask myself those questions, and I keep reviewing the same checklist. The companies go through the same checklist, but companies which have been there with me for 30-40 years is something which I don't even check. I don't even check the quarterly results of a P&G or a Colgate or a Nestle or a Cummins. But now I think I will have to be a little more careful. Sometimes I lose patience and sell, and then I regret. So that happened in case of Reliance. For 5 years my decision was right, and then I didn't move in fast enough, but then at least I moved in, right? And after that came the bonus and the split, the bonus, whatever. I think it was a bonus, and those things helped. And then the company raised a lot of money abroad during the COVID times. That helped, but I got in and got out, and then I felt that I need not have got out. But then 5 years I enjoyed the getting out. So I don't know, these are again conflicts. Based on all this, I create my portfolio. I still make a lot of mistakes, so I will cover my mistakes separately. This video has got too long. It's already 15 minutes. Thank you.